So thanks for joining us, Peter, to talk through the full year results.
Good morning, Michael.
So it's clearly been a year like few others in the bank's history, and there's a lot of moving parts, the deferrals, impairments, notable items, etc. But performance picked up in the second half. So I'm wondering how you're thinking about these issues and if you feel like you're getting your arms around them and can now start to look to the future.
Well, we did have an improved performance in the second half, and that was really off the back of lower provisioning for bad debts. And how to read that is we're seeing a slightly better outlook than what we did at the half year. So we didn't need to put away as much provisioning as we did in the first half, and it reduced quite significantly. So the forecasts are slightly better than what we had at the half year. We also didn't need to change the weighting to the downside in our provisioning. So that was a positive piece. In relation to notable items, my priority was to resolve the AUSTRAC matter, and we did that. We did need to recognise an additional $400 million of provisioning for the penalty, but that's been done now. And that sees us focus on the initiative to improve our risk management capability, particularly in financial crime looking forward.
So in terms of the dividend, the board's opted to pay a second half dividend after not doing so in the first half. So obviously some good news for shareholders there. But walk us through the considerations and how the board went about this decision.
Well, I think the first thing, as I said in the previous question, is the outlook looks a little bit better than it did at the half. We also have a very solid capital position. So we ended at 11.13% on our Common Equity Tier 1 ratio. That's well above the unquestionably strong ratio. We recognise that dividends are very important for retail investors, and that's why the board has determined a 31-cent dividend, and that's the maximum that we could pay out under the current APRA guidance on up to 50% of statutory profit that you can pay out.
And a related issue in terms of capital is the review of specialist businesses, given there's $4 billion odd of capital tied up there. Can you give any update today on how that process is going and anything around timing?
Well, the specialist business unit, the good thing is it's up and running. It's been established. We announced it at the half year, and we've spent the time this year to get it up and running. And Jason and the team are working very hard on progressing those businesses that we expect to exit. But there's no specific updates today other than to say we are working very hard to exit those businesses.
Well, one notable update today is around the loan repayment deferral packages. And if I look at them, it's been quite a sharp and remarkable drop in packages outstanding. So is it a bit of a situation where that's obviously very positive, but there's still a lot of uncertainty heading into next year?
We have had some very encouraging signs in terms of the number of customers now returning to repayment. So in mortgages, we're now down to 4% of the portfolio on deferral in Australia. But more importantly, we're also watching the number of customers that actually make the repayment, and that's at 97%. So we feel very encouraged, but there are still a lot of customers needing help. It's around a bit over $16 billion in terms of that portfolio. So we know that many of those will move off the package to individual assistance next year, and I'd certainly encourage them to talk to us early in terms of if they need more help. In the small business side, again, very pleasing trends in terms of the reduction of people on the packages, but it's earlier days. We're just at the end of the 6-month period, so we'll be really looking at how many customers make those repayments over the next month.
And clearly a lot of this comes down to how the economy performs next year as government supports roll off. I noticed though that Westpac's chief economist, Bill Evans, did recently upgrade his growth forecast, and he got quite a bit more bullish on house prices. So if you put that together with the reopening in Victoria, which is obviously good news, are you getting a bit more upbeat on the economic outlook?
I think certainly compared to where we were in March and April, we are more positive. I feel that as well. It is looking like we won't have as much challenge in the economy as what we thought back then, but I'm still expecting some lasting impacts for some customers from COVID. So that's an important point about customers need to talk to us early so we can help them. But from a general perspective, yes, I think the government's stimulus package, the budget have been very welcome for the economy. The liquidity that the Reserve Bank has provided, the lower interest rates, the dollar remaining low are all very supportive. And so the outlook has improved from March.
And speaking of the RBA, the board is meeting tomorrow. It's a big event. There's expectations of further rate cuts and a step up in the bond buying program. I'm interested though, how much bang for buck you think we're going to get at this stage of the cycle, given interest rates are already so low?
Well, I think there's always a number of factors in the economy, and I think we've got to broaden it out and recognise that the government's provided unprecedented stimulus to the economy, and that was needed. The Reserve Bank's provided liquidity and dropped rates, and the banks have had a role to play with their deferrals. One of the pieces about interest rates, though, is it's also important from the competitiveness of Australia through our currency. So we not only need to look at the borrowing rates in the economy, but also the currency. And certainly I think the impact on savers, so self-funded retirees in particular, are doing it tough because of these low interest rates. So it's always a balance when you set these settings, but in general I think that they've been supportive to the economy.
And looking ahead, you've just confirmed you're in for the long haul, so to speak, in terms of your role. And today you're talking about 3 key priorities of fix, simplify and perform. So give us a bit of a feel for what that means for some key issues like costs and mortgage growth.
Yeah, so yes, I have agreed with the board that I'd move to a normal contract with 12 months notice. We've removed the 2-year contract, so that shows my commitment to the plan to execute it within Westpac. In terms of my priorities, fix is really about, we know we have some issues in risk management. We know we've still got to do some customer remediation. We also have to reduce the IT complexity that we have, so we want to make progress in all those areas. Simplify, it's about simplifying our portfolio of businesses. So the specialist business is key there, but also making it easier for customers by simplifying our products and processes. Then in perform, it's about more customers and growing the business, having highly engaged staff. Our big focus next year will be on mortgage growth. So we've struggled to get mortgage growth this year, and we need to turn that around given that is the heart of the consumer bank at Westpac.